When the market is doing well, it seems as though investing is strictly about the wisdom of knowing where to plant, when to water, and having the patience to wait for it to grow. But in fact, both in good times and in bad times, investing is really about managing your emotions. If you want to be an investor, you have to grow to understand not only the relationship between risk and return, but also your own reaction to it. There are 4 deadly sins that will keep you from managing risk appropriately: ignorance, greed, fear, and pride. Many investors don't understand their own emotions, or they choose to ignore it. In fact, they've made significant financial mistakes, and by mistake, I don't mean losing money. We all make those mistakes. It isn't necessarily a mistake to make an investment and lose money on it. What I'm talking about are mistakes are the actions where the emotions of greed, fear, or pride have caused us to fail to act in accordance with our values. We've invested in something that if we believed in our values, we would not have invested in. Here are the 3 deadly sins and how they affect you. First of all, greed pushes us to concentrate in investments with the possibility of large returns without determining if that's in the best interest of meeting our financial goals. Greed causes us to chase returns. We're trying to put all of our eggs in one basket because we think that basket might do really well. If you set your sights too high, the investment return spread becomes very wide, and a big portion of that spread might be below meeting your goals. If you're less greedy and you set your sights just a little bit lower, it narrows the possibility of returns, and that narrowness means that they all might be above meeting your goals. We had one investor who thought he was diversified because he owned 6 mutual funds. Every single one, the primary holding was Cisco. They held these because they were all 5-star Morningstar funds, and they thought, well, I want to be in the best possible funds, the one that are earning the most money. And during the tech bubble, people were taking money out of growth mutual funds to put them in aggressive growth mutual funds because they were just too greedy. 30% return wasn't enough. They wanted 40% return. Diversification is one of the antidotes to greed. Diversification provides a means of safety. Diversification, on the other hand, always means having something to complain about. When you diversify in a lot of different categories that on average do well, then you will on the overall have a better chance of meeting your goals. We had another client, a younger wealthy client, that thought that a $25,000 investment in venture capital was an amount that was small enough to lose without having any effect on their retirement. But at any conservative rate of return over his 50 years of accumulating, a $25,000 loss when you're young results in millions of dollars when you reach retirement. The immediate loss is tragic because of the lost opportunity for more likely consistent growth in the markets in a diversified portfolio. If greed is the first deadly sin, fear is the second deadly sin. And a lot of asset allocation is balancing greed and fear. Get-rich-quick schemes never work, but neither does giving up too easily. Successful investing simply means following the balance of greed and fear. And without that balance, fear can drive us away from investments with a good historical return. One common mistake during retirement is to emphasize interest and dividend payments over growth in a portfolio. Portfolios at any age need a component of diversified growth in order to keep up with inflation. Inflation means that in 1970, a $170,000 portfolio is the equivalent of a $1 million portfolio today. And inflation means we need to have that kind of growth in order to maintain our assets. Being conservative during retirement doesn't necessarily mean settling for lower fixed income returns. It begins with being conservative in the amount you're withdrawing in order to ensure that your money will last your lifetime with an ever-increasing standard of living. The last deadly sin is pride. Pride makes us want to have done better than others, no matter what risks were taken. We want to beat some benchmark like the S&P 500. We want to surpass our projected goal. We want to have done better than that obnoxious person at work who's always bragging about their investments. It takes a spiritual compass to keep those sins in check and follow an investment philosophy that's consistent. Managing money is easy but managing the emotional experience of purposefully exposing yourself and your finances to the hope of gain and the risk of loss is the hard part. Risk is much more than just quantitative numbers. Risk is about understanding your own greed, fear, and pride.